San Luis Obispo Real Estate Podcast with Mr. Hal Sweasey. How you doing, sir?
You know, James, it's a great day.
It is a great day.
Thanks for having me.
Oh, wow. Really?
Yeah, I'm serious.
Thanks for having me.
Great.
Yeah, and Bobby, you're here. How are you?
I'm here. I'm happy to be here.
JT?
Oh, I'm so excited about this episode. Yeah, this is going to be great.
I know. We had to stop you guys you started the episode before I turned the recorders on, so we had to stop you. I was looking at Bobby and giving her the cut sign, the hook.
I thought you were saying keep going.
No, I was saying Bobby because she knows my signals. I'm like, guys,
gotcha.
stop talking. Hal, we got a lot to talk about. Let's go ahead and get rolling. And who do we have with us?
We have a special guest, Mr. Ben Lerner from
Thank you.
Certainty Mortgage. Ben, how long you been doing mortgage loans?
22 years.
22 years. Seems longer than that.
Thank you.
Yeah. I helped you with your first house.
You did?
Remember that house?
Yeah.
You remember what you paid for it?
I think it was 174.
Sounds about
downtown
right.
San Luis Obispo.
Yes. Okay,
yeah.
good.
What's it worth now, Hal?
Probably a little bit more. Yeah. It's gone up in value. So, but it's not for you because you sold it.
No.
Okay,
No.
good. But so anyway, we're glad to have Ben here because we just had a Fed meeting, right? There's all
Correct.
this discussion about mortgage rates. But James, can I steal the mic and just own it for like 20 seconds?
I mean, you own the show.
okay.
Yeah.
Well, good.
Yeah.
Monologue?
Mono.
A little bit, no.
Yeah.
So, I was watching someone else because I watch a lot of podcasts and listen to things, and they were talking about, I'm kind of thinking of cutting out of social media because honestly, other than what we do here, I'm not a big user per se.
Right.
And, you find stuff and headlines are attractive or frightening, it can be divisive. So, when we started doing this, our goal was to, one, have some fun, right? Two, just pretend we're at a bar having a few beers talking about what we talk about or in the office all the time. But three, information that if our roles were reversed and we'd be listening, it'd be information I'd want to hear and have. So we try to provide helpful information and actionable solutions because a lot of what we see are challenges and problems, which guess what? We've had those forever in humanity as far as I've read, right? And how do we cope with those and what do we do? So anyway, we're here to be a resource. So thanks for listening. Thanks for showing up. And Ben, what happened yesterday at the Fed meeting?
Yeah, I mean, there was no surprise to the Fed meeting. We knew that there was not going to be a change to the Fed funds rate from the meeting. What was really important was we had the economic projections, the dot plot put forward, which is when the anticipated rate cuts are going to be. And mind, those have changed every single time they've been presented. So they're really, I think the market doesn't give them that much credence. But at the same time, the press conference is always really the highlight of the meeting.
Right.
And basically, there wasn't a lot to gain from it, but the market seems sanguine over that. They didn't really respond in a negative or positive way. Basically, Jerome Powell said that we're going to be patient and that we're also on the ready. So they were basically saying we're ready to hit the button and that we're in no hurry to hit the button.
Okay.
So that was basically the...
Patient and ready.
Okay.
I don't even know what to do with that.
So my answer is yes and no.
Yeah, that was
I don't
basically
like that.
the conference.
Okay.
So how does it boil down to someone that has a mortgage or thinking of getting one in terms of like, mid to end June here when we're recording? I don't know what day it is, but by the time this shows up, we're 30-year mortgages now, roughly.
Yeah, a good, clean 30-year fixed rate loan, conventional financing, meaning not government, is somewhere in the mid to high sixes today at 0 points. It's been in a very tight range for the last 2 months at least, not getting a lot of reason to change.
Right.
And there's a lot of economic uncertainty out there right now, and that's keeping rates in this narrow range that we're in.
Okay.
So they need a catalyst to break out of the range. We need, a sure path on tariffs, or, I always say doom and gloom is good for rates. So if we go to war here, then unfortunately bad for the world, good for rates.
Yeah.
So that's how the way.
He went there.
Yeah,
Okay.
sorry.
Okay.
I feel like I should dress in goth sometimes.
Right,
So,
yeah. I think we talked about, so you bought your first house in the 90s, right?
Yes.
What was your mortgage rate back then? Do you remember?
I think I did an FHA loan for our first loan.
Yeah.
And I borrowed the down
had no
payment.
money.
I had no money.
Okay.
I borrowed the down payment from my in-laws a block away.
Okay, good.
And I want to say we purchased that home for $174. And then we refinanced it. I think I was at 7.25%, if I recall.
Yeah.
And I think the rates were on the way down at that point. It was the 96, I think.
Yeah.
And I think we got into the high sixes, maybe a month or two later, we literally refinanced into conventional financing.
Yeah, because to me, having gotten used to things, 6.5 to 6 3/4 is good.
Yes. Historically, we're in a good spot.
Yeah.
Yeah.
What year did you say that was?
I want to say it was 96, 97.
96, 97. The average rates were 7.6 to 7.8.
Yeah, I had a good lender.
I got the rates for the last 47 years.
Yeah. Yeah.
fun.
Yeah. And FHA is typically less than conventional. So that would make sense, about 7.25.
So you weren't in the business when you.
I was not.
Okay.
I was not.
So is there any reason that you went with a 30-year at that point as opposed to like ARMs were popular in that era, right?
Correct. Yeah. Even today, the pickup of $100 a month on an ARM versus a 30-year fixed, unless it's, a large loan amount, it's still, there's some, every borrower needs to know what they can sleep at night with.
Okay.
And one of my first conversations with a client is, if you do a 7-year fixed rate ARM, are you going to go to sleep tonight counting I have 6 years, 364 days to go before I need to refinance?
Right.
Or am I going to sleep well at night knowing that I'm in this loan program? And if you're the type that's counting the days, that's not the right program for you.
Right.
What percentage of loans that you do today are ARMs?
I would say less than 5%.
Oh, really? I would have guessed a little higher than that.
So all 30-year fixed.
Mostly 30.
Not even the 7 and 10-year fixed. It's,
Correct.
Okay.
Yeah.
Wow.
I get it.
Yeah.
I'm surprised.
Safety, right?
Yeah, I think so.
get
And I think it makes me feel more responsible too after the financial meltdown of 2008, when I was in that crisis. So many people were on pay option ARMs, and which were the pick a pay or the no income, no asset loans, or we all remember the subprime 228 loans, which were 2 years fixed and then they adjusted, but they had a 2-year prepayment on them. So you couldn't get out of them until the adjustment. They were horrible. Yeah. And so that's sort of a product really, it made an impact on me and how I talk about loan programs.
So it sounds like you're not using many creative products today. You're mostly just staying with the conventional 30-year loans.
Well, I think overall the monetary money right now is very liquid. And when I say that, just to put a fine point on that, if you go back to 2008, the cycle of money stopped. Basically, banks only have so much to lend, which is why we have Fannie Mae or Freddie Mac. They buy the debt from banks so that the banks have money to lend out again. In 2008, there were no buyers for the debt from banks.
Right.
And so banks have a finite amount of money, so guidelines have to contract because now they want to be very careful about who they do a loan for. It's common sense. They have to protect their money. And money slowly loosened up. That's why Fannie Mae and Freddie Mac became government-sponsored enterprises as opposed to private companies, right. And they still are today. It's a hot topic. But right now, money is the opposite. There are plenty of buyers for debt right now. And so what that leads to is that guidelines, creative programs, all of that stuff, there are an abundance of them out there. So to answer your question directly, there are many, many solutions that used to not exist even a couple of years ago that are available for our clients to get into home loans.
So what are one or two of those things that you use, especially for like an entry-level buyer?
Yeah, even on an entry-level buyer right now, you don't have to do a Fannie Mae type of loan. People think jumbo or non-conforming, which are synonymous terms, are only for higher loan amounts. Those programs actually go down to $100,000 loans, sometimes even less. And
if I'm a first-time buyer and I don't know what jumbo or Fannie mean,
Yes.
what does that mean for them?
Yeah, going back to what I was saying before, when you do a conforming loan, that means it conforms to Fannie Mae or Freddie Mac guidelines. That's literally what that's referencing. Okay. So that means that they will buy that debt from the bank. And so it becomes a conforming loan. The non-conforming loans are loans that don't meet those guidelines for one reason or another. And so we typically call those jumbo because Fannie and Freddie have a maximum amount that they'll buy, a loan amount.
Right.
Non-conforming is for above that amount, but it also goes below that amount.
Sure.
And that's what a lot of people don't realize. And so those programs, going back to what makes them unique, a very popular program right now, it's about 20% of the business are what are called non-QM loans or non-qualified mortgages. And these loans, meaning they're not qualified to be insured by the government. And that means they're portfolio money, basically. But they're very creative. And again, there's lots of money out there right now. So these are very easy to obtain. And the rates are very similar to a normal loan. Mm-hmm. And they allow you to do things like take a borrower's wages and combine them with a depletion calculation of their assets. Meaning, let's say somebody has $1 million, but their cash flow as their job doesn't qualify them enough for the mortgage. We can then take their job and we can add a calculation to their assets without touching them that gives them an income calculation to qualify them.
Okay.
And
gotcha.
So that could be every $1 million, for example, just off the top of my head, is about $12,000 in income on most of these programs.
So it qualifies based on another $1,000 a month in income.
Correct.
Like things like buy downs, is that still as popular these days as when the market
I
the
haven't
rates went
seen that as popular. It's
Okay.
funny. It was
We're all
popular.
pushing that for a
Yeah.
while.
Well, that's when you went
Yeah.
from 3 to 6. It's like, well,
Yeah.
I can't
It was a big
afford
deal.
that.
Every
It
Instagram
was a
video
big
was
deal.
about buy downs.
Yes.
Isn't that interesting though? Because when you go through the shock effect, mortgages were 3 and they went up to about in that 2022 end of the year 6 to 7. Did they hit 7?
Yeah, we were over 7. of
Yeah,
course.
so that's a doubling.
Yes.
Then suddenly, oh my gosh, we need help with this, and now people are coming out, and maybe you're not buying, or they're just saying, oh, it's just what it is.
I think that the buyers are used to the rate environment that we're in now.
That's what I
think
mean.
it's been long enough that it's not a surprise where exactly like you just said, it was kind of a shock and awe when we went from 2.5% to 7+%. And
Yep.
now I think that they're used to seeing that. And they're used to hearing 6s.
Isn't that amazing what we get used to? So I have to ask you though, do you think buyers are missing an opportunity by not having that same strategy today?
I think if they can afford the 6s, that a better seller strategy, in my opinion, is helping with closing costs or helping in other ways versus the rate.
Okay, so you'd leave the rate alone.
So there's been some calculators that I've seen online that suggest, I'll just throw out a number that you ask for a $10,000 concession versus a $10,000 price reduction. You use that $10,000 to buy down the rate, and
Way
the
better.
difference in payment it runs in your favor.
Right, because you can always refinance lower, and
Yeah.
you likely will, versus that, saving $100 a month versus saving, it's not even, it's $60 a month for the example you just gave on a $10,000 reduction versus having $10,000 more dollars in your pocket.
Right.
Got it.
It's a
So
lot-
maybe
lot of
those
difference.
calculators are a little bit misleading, kind of like the rest of the internet. And
Well, the internet, as we talked about, right? 80% of what's on the internet is fake. Abraham Lincoln said that.
Yes. Yes. He started the internet.
He did start the internet.
so what's the demand for loans look like right now? Are you receiving relative to other times the number of applications you're taking?
Yeah, I would actually say applications are high. Escrows are, I would say, maybe right about an average year right now. I'd say the beginning of the year was busier in our office, and right now it's probably right on average. So we went from above average beginning to an average right now is where I would put the business. But applications, going back to that, I'd say are above average still.
And that's usually an indicator of where we're going. So
It
what
is.
are you seeing coming up? What if you were going to make a prediction?
Yeah, I mean, I really hope, and no politics in this at all. Whatever happens with tariffs, whether tariffs are instituted or not, just having a path on tariffs will help the market, in my opinion,
Yeah.
on the housing market, because I think that the uncertainty is brutal.
Right.
And then I think, go ahead.
Does that apply to the legislation that's pending as well?
for the
fact
big
that
beautiful
just
bill?
get it done one way or the other, and
I don't know if that is, obviously there's salt tax in there and stuff where the state and local taxes are in there and some of those. I don't think people are in my conversations, I haven't heard that come up as much as the uncertainty of the tariffs. So I would say the tariffs, having a resolution is going to be helpful regardless. That's just to have a path.
isn't that in part what Powell was saying?
I think so. I think Powell yesterday was discussing how, here's going to be the initial hit to the tariffs. It's a one-time hit. And, after that, it'll blend in. And I think they're less concerned with it than they were 6 months ago.
Okay.
Okay, so here's something, and I'm just dangerous enough to ask this question because I did sleep at a Holiday Inn last night.
Yes.
So the Federal Reserve lowered the rates last fall. Mortgage rates followed suit for a little while. Then they went up. And so somebody made the point, and this is new to me, so I'll let you comment on it because you know more. And I'm walking in dangerous territory. But the Fed, if they were to drop their rate, 0.5%, 0.25%, whatever that is, call it 1%. For us that are lay people, that hasn't affected the longer term rates, which is the 10-year. Those have been going up in spite of that, meaning the market is not saying, nah, we're not lending you 10 years at that rate. We're going to be up here because we feel, that there could be more inflation over time. So is the Fed responding to what's occurring and then trying to fix it, or are they leading the rate? Because people always go, when is the Fed going to drop the rates? I go, well, I don't know if that's going to be the impetus that changes it.
Right.
It might be the response to like, oh, we got to drop the rates. I don't know what is your
Yeah,
what
I mean,
you told in the big bond market.
Yeah,
you
I
know,
mean, that-
they're lending guys. They're super
This
smart.
could be a 3-hour.
Okay, let's make it really.
Question
Remember
from
who
when
just
you
asked the
met him.
question. Let's keep it really simple.
Keeping it high level. I mean, the
Low
Fed's
level.
We want to understand.
at 40,000 feet, the Fed's mandate is stable employment and stable economy. You know, their job is to look at the future.
Inflation and jobs.
Right. They're not supposed to be reactive. They're supposed to be proactive.
Mm-hmm.
And, you know, and we are what's called a boom or bust economy. In other words, the economy's always going boom or always going bust.
Mm-hmm.
And that's just the nature of a capitalist economy.
Mm-hmm.
And their job is to try to smooth out those booms and busts as much as they can. And their main tool is the interest rate on the Fed funds rate.
Right.
So when you talk about the Fed, they're supposed to be looking forward, is the short answer on that. As far as the 10-year goes, in broad strokes,
This is the 10-year Treasury, and
The
that
10-year
rate
Treasury.
is what
Let's talk about the bond market in general.
mortgage rates follow that, so that's why we bring up that 10-year.
correct.
Right? It's not
Mortgage
the
rates in
2-year
general
deal.
follow the bond market.
Okay.
I would say, in broad terms, the stock market is emotional. So every day it's responding to feelings going on. Do things feel this way? The bond market is reality. And the bond market looks at facts, they look at figures, and they look at what's likely to come. And you have different length bonds. We have, 2-year, 10-year, 30-year bonds.
Yep.
And those are projections. They're trying to make projections onto long-term debt.
Right.
And so they look at reality, not emotion.
Yeah.
And so when you see the 10-year hanging there is a variety of reasons. Tariffs, uncertainty, right now a weakening dollar, all of these things, the debt ceiling, the deficit, all of these things impact our bond yields. And we need to attract buyers to those, and we need to also keep the rates down. So there's a delicate dance happening on that.
Okay.
That's a short answer.
Well, that's good.
That was a good
I'm going to
description.
I'm going to go back in the sandbox, get off the street where we were just playing, and let's go back home where I'm safe. Talking about real estate.
Okay.
Okay. Thanks for
Sure.
humoring me on that.
Yeah.
So after all that, what do you think is going to happen in the next few months? And I read an article today in the local paper, and it was kind of like, if I was reading that article and I was believing it, I would, and I was thinking about buying a property, I'd run the other way.
Yeah.
So, one of my great mentors, you've all heard this, said, when you think you can, you're right. And when you think you can't, you're right. So how can we help people think they can buy a house?
Yeah, I mean, I'm going to be an optimist here on as far as the future right now. I think that rates are restrictive right now. I think that they are too high. I think you would be challenged to find a good economist that doesn't agree with that and who doesn't also think that over the near term, we will see rates go down. How much and how quickly is the trillion-dollar question. And I think that goes back to that uncertainty right now. As those fears are fleshed out, I think we'll see that happen. And unfortunately, I think doom and gloom also pushes that equation further forward. Right now there is potential for some doom and gloom, and that doom and gloom is good for interest rates. So in short, though, as I know you talk about on this podcast, we are short on inventory. Home builders are not building enough homes. As a matter of fact, new housing starts are at way too low right now. So we're not keeping up with demand for housing. And so in the near term and in the long term, I think we'll see home appreciation stay strong.
So I'm a first-time home buyer. I'm just struggling to push the go button. I mean, I'll figure out a way to get in, get my down payment together somehow, some way, whether it's 3% or 10% or 20%, right? How are you advising me in terms of helping me feel good about pushing the go button?
Yeah, when I meet with a client, especially first-time home buyer, my general tact is, get to here, never above the nose. It's no fun living on top ramen and oatmeal, and that's not my goal, to get people into houses where they're house poor. I don't believe in house poor. I think that's a poor term. But I think stretching a little bit, getting in, is a good idea if they have job stability and they're on the up. And by that, I mean, everybody that's purchased their first house knows how how much of a struggle that first year may be. Those payments are big, and you get that. If you buy the right house, it's going to hurt a little bit at first. Second year, you get your tax benefits from the interest that you're paying and the property tax write-offs and everything else. Maybe your job, maybe you're making 5% more, maybe more. And all of a sudden it starts to get a little bit easier, and that payment is fixed as opposed to rent, which can go up every year. And so it gets easier and easier. So my tact is, when you're ready, take the step and get in there, and it gets better every year.
I think we need to have a follow-up podcast on this, because I think there's a lot we can share that people that haven't made that step or hit that button could learn from.
Yeah. I think the title of the podcast ought to have the word affordability in there somewhere, huh?
Right. Because a lot of people don't get that news. So let's talk about that next time. Because when you talk about Stretch, he always bought as much house as he could, and I was the opposite. Right.
I think it's timely. Would you come back next week?
Absolutely.
And we could talk about that one?
Absolutely.
Yeah, that'd be good.
All right.
Thank you.
So rates 6.5 to 6 3/4. More applications, and there are lots of avenues people have to be creative, and they won't find out unless they talk to someone like you.
That's correct.
And how would someone like you be reached?
You can reach me on my cell phone, 805-441-9486, or simply go to blerner.com, and that's BLERNER.com.
Okay, I'm going to do this to you.
Okay, lay it on me.
Hot seat time.
Oh, yes.
Oh, here we go.
I've given up doing this myself because I did it a bunch since we started this podcast, and I've been wrong every stinking time. Where are the rates a year from now? 6 months from now?
Just January 1st, 2026.
And a year from today.
Here we go. We're gambling.
1st of July.
I'm going to say January 1st, so 6 months from now, I'm going to put us down 6% on the money.
6% for Ben.
Wow.
Okay, good. And now the loser of this has to get their ears pierced.
Again.
Okay? So,
I was gonna say, just shove one
okay,
through.
John.
I can't. They won't work with my hearing aids.
Okay, we'll pierce something else. Okay, what's
No,
your?
I'm not doing it. I said I don't do that anymore.
No.
But I'm not in the lending business.
Okay, John's saying 5 1/4. 5.25. I know one of those piercing people.
Tell you the truth, I thought Ben's answer at 6 is optimistic, and I love that. I optimism trumps pessimism every time. Where is it a year from now? What do you think?
I don't think in a year from now, I think it's going to creep after that. So I'm going to say 5.75.
Okay.
Okay.
So if we can get between 5.75 and 6.
Hold on, we have a competition.
Oh,
Yeah.
You have to give it numbers.
You
Sorry,
guys,
T.
you gave me such a hard time last time we did this. What did I say last
That's
time?
our job.
We've
I
already
said
forgotten.
like
Yeah.
6 and something, and you guys were like, and now all of you guessed 4. So I'm
we
not
ganged
doing
up on
it.
you.
No, I didn't guess. Nobody guessed 4. Okay, so go ahead.
You're gonna
What's your
you're gonna
number?
have to be responsible to pull that out.
I
I
will.
mean, why would I contradict what this guy said? I'm just gonna follow him.
No,
Nobody-
listen,
no.
you have nothing to lose. Go straight optimism on this. And you already have your ears pierced.
Yeah.
I mean, like,
Okay, well, good point.
Yeah.
So you got nothing to lose.
2.75.
So if you're just having fun.
Okay, I'm
You
gonna
have to get a
go-
tattoo
I know.
on your neck.
Okay, there you go.
On your
This is a
neck.
crazy podcast.
Prison tattoo.
I'm gonna go
Ben's
a
got a
little
guy.
lower than 6. Then I'll go.
Okay.
I'll go the 5.75.
5.75.
This
Bobby.
is 6 months. You're saying 5.75.
This is January 1st.
Wow.
I thought
January
we were saying
1st.
a year from now. Sorry.
Okay, this is that's your year.
That was my year. Yeah.
Okay, so that's going to be 6 of 26. Okay, and Ben said 5.75, and John recused himself. So you want to?
I'm out.
You want to correct the 5
you can't.
1/4?
John,
I'm
you're
out.
pretty good with an
He's at
earring.
the 5
Come on.
1/4.
You have
so I'm
to.
going to cover the bases. He's going to be at 6% in a year. So one way or another, he's going to get his ears pierced. Okay, good.
I'm going to go 7 because I've been wrong every time. If I say 7, maybe it'll be 6.
They
Now
have
you're
been wrong every
thinking.
time.
Okay, good. All right. I'm going to say 5.9 in 6
Oh,
months.
geez.
And I'm going to say 5 1/4. First time I'll be the lowest, and that's in 1 year.
Wow.
Yeah. Okay.
We'll be
All right.
cruising.
Whatever that means, we're going to find out.
That'd be great.
I
Okay.
hope you're right.
Do you know what that would do for the economy?
It would
Oh,
be-
my gosh.
I think just a 5 does magic for people.
Oh.
And then we're not even talking about government. Right now, government is closer to 6. So I think even, the FHA, VA, USDA buyers, those people, even getting a 5 in front, it's meaningful.
The most activity in Hal's office last year was, to use Albert's term, when Albert, the owner of the company who was with us occasionally, said when rates kissed 6,
Yeah.
our activity picked up.
Oh, yeah.
Yeah, last September.
Yeah. For a
we were
week.
trying to get the word out.
Yeah.
Because it was so much different. It had gone down
Yeah.
a full percentage point, right?
Yep.
Yeah.
And look at the difference. So
Yeah.
interest, what's going to happen? Interest rates.
That was deceiving too, though, because people said they're coming down. Now we're really going to hold on and let them keep coming. And look at how quickly those people
Waiting
swore
is a
that got
wonderful
in.
thing, isn't
Yeah.
it?
Yeah.
It's- no, I'm sorry. It's not.
It's not a wonderful.
So, James, when's
Yes,
the
sir.
best day to buy real estate?
Yesterday and today.
Yesterday's the best day. What's the second best day?
Today.
Today.
Since we can't get yesterday again.
I mean, we could try.
Yesterday's gone.
Once
Yeah.
you get those things pierced, it's over.
I brought a couple other numbers that just might be some fun to close this out.
Should we do it this week or
I
next
think
week?
we-
No. We're gonna
Let's do it now. Okay,
Yeah.
good.
All right,
Yeah,
we're maxing this one out.
Average price of a home in the U.S. 1975. What do you think?
Average.
1975.
Yeah.
27,000.
94.
Nah, you're way off. 38.
38 and 75.
38.
That makes sense.
Wait,
That
wait,
was a-
wait.
that was-
10
'cause
years
it's national.
later,
Yes.
what do you
Okay,
think?
Okay.
What's that? 10 years
10
later?
years later.
85?
42.
56.
What was the first one?
80.
I don't know.
82.
94.
Oh, wow.
So wait, it went from,
10 years later, 95.
okay,
97.
125.
130.
Okay, good.
10 years
if I keep
later.
saying 125, I'll get it
10
right.
years later,
228.
2005.
2005.
Oh, wow.
Oh, 2000.
210.
I'll go to 200.
232.5.
Oh.
That was
10 years later, 2015,
305.
289.
Wow.
10
guys are
years
saying anything.
later,
Thinking about this
10
year.
years later, 2025. This
that
form says over at 417. I think it's more like 420 or 425
Depending on the
recently.
week.
That was in the Q1 of this year.
Amazing.
So, when's the best time to buy real estate? And the
Anytime.
answer is always yesterday.
1970s for sure. Yeah.
Yeah.
It-
Best asset class you can buy.
the Keller Williams owner said a couple years ago. Remember what he said about waiting?
Oh, yeah. Don't wait to buy real estate. Buy real estate and wait.
There you
then
go.
it's good to wait.
That's a mic drop
And you
for
can
this
buy.
episode,
There you
don't
go.
you think? Hey, James, get us out of here.
Don't drop my microphones. But yeah, a fun episode, Ben. Thank you for being here. Hal,
Thank you.
anything else? Go once,
No,
go twice.
look forward to having you back next week. Thanks, Ben.
Yeah, awesome. So
Thank you
everybody,
very much.
everybody listening and watching on YouTube, make sure you like and subscribe. And Mr. Kingman, what do you have for us? Anything?
Also, do the same thing on wherever you get your podcasts. It's called the Slow County Real Estate Podcast with Hal Sweasey. Lots of characters to type in, but just look
yeah.
it up.
You
Look it
know
up.
what,
That
James?
is what we're called.
The best thing that could happen to us is
Yeah.
somebody listening to this podcast lets us know that because of something that they heard, it helped them make a decision,
Yeah,
bettered their lives.
Education is the key. Get to know.
absolutely.
Thanks, you guys.
That's a
Absolutely.
good reminder for comments and questions. We want all the questions. Send them.
Bring them on.
Bring them on.
All right, everybody. Thanks so much. We'll talk to everybody next week.
All right.
Thanks, James.
Thanks.
Awesome.